Travillian Next is a division of Travillian, a financial services specialist search and talent advisory firm. Since inception, the Travillian team has dedicated itself to enhancing the return on investment of a company's most important resource, its people.
Hello, everyone, and welcome to our Board Insights podcast today on board talent. I'm Indra Elangovan, and I am the head of strategic advisory at Travillian, where I focus on board advisory services designed to enhance organizational effectiveness. We provide board search, talent recruitment, strategically attracting top-tier talent to enhance bank boards. Our recruitment focuses on multi-year succession planning, diversity of expertise, and optimal board composition. We also provide board assessments that ensure a strategic and informed approach to board composition and succession planning, among other board deliverables. Today, we have brought together a panel of experts to share their perspectives on board talent and expertise. I would like each of our panelists to introduce yourself. Let's start with Caroline. Let's go through alphabetical order. And Caroline, would you please share us your background?
Thanks so much. I'm Caroline Stapleton. I'm a partner at Orrick in the DC office, and I advise financial institutions, including banks of all sizes and strategies on financial services matters, consumer protection, safety and soundness, and regulatory and statutory compliance.
Great, thanks. Welcome, Caroline. Next, let's start with Julie. Would you share your background?
Sure, thanks. It's a pleasure to be here today. I'm Julie Stackhouse. Until I retired in 2020, I was the Executive Vice President of Bank Supervision for the Federal Reserve Bank of St. Louis, and also ran the community outreach and learning functions for the Federal Reserve. I am now a director of Simmons Bank and Simmons Bancorp in Arkansas, and among many other community type services that I do.
Great, welcome, Julie. Next, we would go to Peter.
Hi, and I'm also thrilled to be here on the panel. My name is Moenickheim. I currently serve as the Chief Risk Officer for Evolve Bank and Trust out of Memphis, Tennessee. My background has always been in risk management, spanning from credit through operational risk, enterprise risk, and the like. Welcome,
Peter. And Peter is also the co-author of the Bank Boards Are They Risky Enough article as well. And next we'll go to Randy.
Hi, great to be here. Randy Lariar. I am the director over our SOC technology practice at Optiv, which has a portfolio focusing on big data analytics and critically AI over the last year. Optiv is a full service cybersecurity provider. We do consulting, product resale, and help our clients to manage cyber and related risks. I've come from the financial services world. Prior to Optiv, I've worked for Big Four Consulting, working in data analytics across banks large and small, and have been fortunate enough to be working with AI and natural language processing for about the last 10 years. And so last year and this year have been incredible to see the growth and opportunity and risk in this space. But there's been a lot of education and up-leveling of organizations to prepare to seize the opportunity while being ready for the risks.
So welcome, everyone. Thanks for joining me today. We recently published an article called Bank Boards, Are They Risky Enough? Through extensive research and data analysis, we presented findings that highlight the lack of board expertise in crucial areas such as risk management, regulatory, cybersecurity, and IT. We also provided recommendations for bolstering bank boards to navigate in today's banking climate in this article. I'm sure you all have read this article, and I wanted to hear your thoughts today. Why is this crucial for bank boards to have this talent or expertise? What resonated with you about this article? Let me start off with Julie.
Okay, thanks. As a former regulator, you might imagine that I've seen every variation in the theme with respect to bank boards. And to some extent, there are some practicalities that are involved, particularly as you get into remote geographies. As I look at bank boards, and what resonated with me in the article is that so much of the choice of board members, I think, really should depend on what are the risks of the bank. I have seen very small banks get into very risky businesses, And I've seen very large banks do nothing but lending, and a subset of their activities are in their investment portfolio, and that's about it. Every bank, of course, will have cyber risk, but to a great extent, you also have to assess how well are my employees able to manage those risks, and to what extent is the board itself involved in having to engage. Once you go through what I'll call that root analysis and you really understand what it is you need, then absolutely, you should be looking for board members who can serve to take the reports that are being provided on those risks, to challenge them appropriately, and serve in that governing role of really adding value. So back to really the root cause analysis, taking a look at what your risks are and then making sure that you have board members that have enough expertise to be able to complement the work being done with management is key. Later, we'll get into how do you find them, but I think, again, it's not a one size fits all. It's very much what do you need for your bank.
Great. Thanks, Julie, for your perspective. Let's move on to Caroline.
So I completely agree with Julie that, bank boards, there's no one size fits all. But the one thing that is applicable to all banks and their boards is that regulators expect them to be appropriately comprised of folks with expertise and talent that is relevant to the bank's strategy, risk profile, complexity, and size. And those words that I just read to you, I did not make them up. They are taken straight from the OCC's director's book for national banks and federal thrifts. And I'll just, not to be boring, but read it to you so you understand the ideal board, this is according to the OCC, is well diversified and composed of individuals with a mix of knowledge and expertise in line with the factors I just mentioned. And although the qualifications of individual directors will vary, the directors should provide the collective expertise, experience, and perspectives necessary for effectively overseeing the bank. So that really sums up what regulators think will best support a bank's safety and soundness and legal compliance at the board level. Members, directors with relevant and complementary talent and expertise. And that viewpoint is generally shared, not just among US regulators. You can find similar guidance in the Basel Committee guidelines for corporate governance. It all stresses this need to have that appropriate level of expertise. And what resonated with me about the article was that everyone does seem from the subset of banks that y'all looked at when writing it, everyone does seem to recognize that banking expertise is really critical, right? And we saw that, pretty much across the board. But, other types of risk management, that's been a huge focus for many years now for the regulators. And so making sure you have that on your board, people who understand enterprise risk management and the importance of it. But also things like cyber, seeing the low number there was interesting to me because even if you're not doing some novel technological, banking service or product, you still are probably using the internet, probably connecting to the broader world around you, and having board members who at least are familiar with the parlance of cybersecurity and able to have those conversations with their management team members who oversee that, really important.
Great, thanks. Peter, would you like to add to that thoughts?
Absolutely. When we started the research, Indra and I, we had some hypothesis that, and we were focusing on risk management because of my background as a chief risk officer for other institutions over my career. There were times where I did not have on that, quote, risk committee of the board, the expertise I was looking for to challenge me or direct me or help with the strategic direction of the bank. And so as that was in my mind and I was talking into, that's what sort of spurred the research. But I would reinforce what Julie and Caroline said. It is not a one size fits all. And a quote, traditional bank that, does loans in the community and takes deposit, probably needs, quote, less of a risk management focus on their board. However, as Caroline mentioned, as we'll hear from Randy in a little while, the banking world, even for vanilla, is changing, right? Online banking is almost uniform. Online payments are out there. And so many banks are using third-party services where they are providing some form of technology. Again, that's a risk even for, quote, the plain vanilla banks. So I think this topic is relevant. And as I also look upon my experience interacting with regulators, as Caroline said, from her chair, they are looking for deeper knowledge of board members in these key topics: risk management, cyber, regulatory relations, etc.
Right, thank you. Randy, would like to hear your thoughts.
A lot of great points are already raised, and the nice thing about financial services and banks is that the concept of risk is also being a good thing and being a driver of the business is well understood, where other sectors, that's not necessarily as well done. So seeking out, the diversity of perspectives and the ability to challenge the status quo or expertise are important, as well as to kind of know when you don't know something in terms of things are changing. And that's a lot of the business of technology and cybersecurity. I spend all day, every day thinking about AI and data analytics, and even I don't think I've fully gotten my head around the shape of changes that are coming to our businesses and society. Not that the innovation, marches on, but also just the concept of what it means to do knowledge work, what it means to transact in a digital business is going to change in a significant way over the coming years. And so you also need to be a board that is able to contextualize that and understand, what that means for the business you support, as well as the markets you serve, the existential threats to your business, both from the way the market is changing, as well as to things you might do, such as have a bad risk management policy to put yourself out of business or in serious jeopardy. So there's major changes to navigate, and so even the most vanilla, repeatable board, I think, is going to be seeing things that they haven't seen before and need to be able to respond to that. On the cyber front, the amazing transformations coming from AI are also enabling attackers. As part of why we're seeing more ransomware than ever, we're seeing more supply chain attacks. I think that the speed from initial breach to the delivery of the ransom or the malware payload will increase. The level of sophistication you need to pull off those type of attacks will go down. The kinds of capabilities you think of nation state actors as having maybe last year can probably be done by a teenager in a basement, this year and next. And so our adversaries are also getting much more sophisticated, which again is another vector of change that boards need to address, and just recognize that the world is changing and needs to be diverse enough to have a good perspective on it.
Right, thank you. Very interesting points from all panelists here. We are clearly in a transformational period. An affirmative board is a thing of the past. The future of the board is going to be more strategic, and obviously, clearly, the role of the board is dynamically evolving. So with that, as you saw from the data analysis, clearly this is a problem, that the lack of talent in risk management, regulatory, cybersecurity, and other skill sets are absent from banks where we uncover critical findings, highlighting obvious talent gaps within boards in these crucial areas of board governance. What is your observation and what is being done about this? I'd like to see what are you seeing out there. Maybe we can start with Caroline.
Yeah, so one thing that I'm seeing is that where boards are lacking some of these skills, they are making up for it by engaging in recruiting that's very targeted for management, maybe recruiting a very experienced or a narrowly focused for their particular strategic goals chief risk officer or chief technology officer, perhaps engaging consultants in cybersecurity to make sure that everyone is kind of assessing where the bank is and where they need to be on defending against those risks that Randy was just talking about. And so having that kind of expertise on the board also would be an excellent complement, because one role of a board is to be an effective challenge to management. And so, ideally, I think what regulators and frankly, we as a society would hope for and expect from best practices from our banking system would be to have a working knowledge of at the minimum and better yet, expertise in these different risk areas, Indra, that you've outlined on the board. But in the interim, because as Julie mentioned at the beginning, recruiting can be really challenging. Recruiting for management is one way that folks are dealing with that. And then also, of course, training. Training is not, vanilla training will not work anymore. Even as everyone's been saying, for a vanilla bank, because of the nature of how our world and this entire financial ecosystem is changing. So, and that extends to board members too, who should be taking their training responsibilities just as seriously as the chief compliance officer takes it for employees.
So given what we've seen in the past year in March of the, a sort of a banking crisis there, and then till the end of 2023, what have you seen some changes in your clients, from a trend standpoint? Caroline?
Sure. So, well, we've seen a very active interest in what are the regulatory tea leaves, and boards are very interested in hearing about that. I think that what happened this past spring was a surprise to everyone, regulators included, but it's been a real wake-up call across the board. So, no pun intended. So I know that board members have been asking us, what can we expect that regulators will expect from us that's different now that we have the perspective of last spring, particularly within, banks at the community to mid-sized level. We know that there's a lot of scrutiny there. There's been, publicly held meetings where we've heard regulators talk about their concerns about that, particular sector. So that's certainly what I've been hearing. I'd be curious to hear others' perspectives as well.
Yeah, let's move on to Julie. Any thoughts to add there?
Yeah, maybe I'll just kind of piggyback on Caroline's comments about what regulators expect, because it seems like over the course of my career, that was always out there. What do they expect next? And remember, I was in a career that went through multiple decades of crises. So, to some extent, even with Silicon Valley Bank, I looked at it and said, well, who couldn't see that one coming? They had $12 billion of depreciation in their bond portfolio, granted unrecognized, and $14 billion of capital. That's a problem. I don't care how you look at that. And I think, that piece of it is what regulators now are really trying to calibrate is there are risks out there that if you use the tried and true formula or the traditional ratios, you're going to miss them. And as a board, you're going to miss them. If you just say, oh, hey, that's depreciation in my bond portfolio, I don't have to worry about that, you're missing the point. There is a lot of risk associated with it. So how do you bring this back to saying we need to be able to, on our boards, really calibrate what our risks are? Because that's what the regulator is going to want to see. And they're going to want to see that you've identified it and that you've managed it. To me, sometimes the most helpful things I've seen on boards are bankers, people with previous banking experience, because it's not a silo that they bring. They're able to look at the bond portfolio, say, and understand how that plays into net interest margin, or they're able to look at segments of the loan portfolio, even the type of bonds that are in the bond portfolio, and really help to calibrate what the risks are. Not to put myself out there, but I will. I also think that having someone with regulatory experience can be very helpful. Now, that's not going to be for every bank, and I don't think you might want more than one of us, but I think sometimes you have to have someone translate what is in the news today, which tends to be all very, very, oh my gosh, this is coming at us, versus what is the likely path that regulators will take. And sometimes someone with ex-regulatory experience can be very helpful in that. So I don't know that's going to answer everyone's question, but having that ability to have a board member step back and really say, let's look at the big picture, let's concentrate on our risks, and then let's have our story for the regulators, that can be very helpful.
Right.
I would throw in there, I don't want to relive the past with Silicon Valley Bank, but as Julie said, they should have seen it coming. And the way I look at it is the Fed gave very clear signals it was going to raise rates to fight inflation. They didn't sugarcoat it. They were very clear. And when they started that process, to me, as a risk manager, somebody should have been working with the finance team and saying, look, interest rates have started going up and we have clear signs they're going up more. this is going to be the impact, as Julie said, to the bond portfolio, and we should start getting out of it or hedging it or doing something now because we know where interest rates are going. And I think that signal wasn't read, action wasn't taken, and we see what the outcome was.
Yeah. Peter, if I could add one more piece to that. The other thing, and I know we don't want to recount the past, but we do because there were so many lessons learned. Those matters requiring attention, that's a big deal. And any board that doesn't put that as a regular item on their agenda is really not doing its job. That is the regulatory signal. So if there's anything that our listeners take away today, pay attention to those MRAs and MRIAs. They mean something.
That's good counsel. Thanks, Julie.
And Julie, to that point, I think that that's why having, someone with regulatory expertise on the board would innately recognize that. I mean, there may be, you may be a bank that isn't used to getting MRAs or, many MRAs or of that severity, and kind of understanding what has to be prioritized at what pace, and how to educate regulators in addition to, defending yourself, seeing that it's not just always a defensive posture, but kind of a collaborative posture too can be beneficial, all of that. And I say that full disclosure as a former OCC attorney, so definitely recognize the importance.
So it appears to me that it's not just about, checking off the box that you have a regulatory, expert on your board and just seeing that, but actually trying to see things ahead, 6 months, ahead, and trying to understand what are the emerging risks and trends, and not as a checking the box from a regulatory standpoint and compliance, I think. Would you agree with that? Yeah.
Yeah. I'd also add there's, you don't know what to look for if you haven't seen it before. And even if you have seen it before, if you don't have systems in place to see it, and board members are very busy, right? A board meeting is a small percentage of the time the company operates, right? So you really need to compress a lot of information into those conversations and what's important and what's not. And call me a data guy where it's a nail hammer thing, but a lot of thought needs to go into what gets reported, how it gets formatted, what issues you bring and put at the top and catch the eye level, and what kind of information is provided as a supplemental that really needs to be super user friendly and super aligned to getting those risks highlighted. It's also something where again, financial services is a bit more mature than other sectors on this. But if you think about the CFO function and the understanding everything down to dollars and cents. You can quantify risk, right, in the terms of what it might cost us if it happens, how likely is it to happen, et cetera. Quantification of other kinds of things, other kinds of operational risks or cyber risks for that matter. It's an ongoing debate, and there's a lot of we don't have time to get into all that stuff here. Just to say that it's important, and it's probably more important that you're asking the questions and thinking about how to bring these things up versus solving it 100%. So if you're not, as a board member or as someone presenting to a board, thinking about how to quantify and how to highlight the most important issues, I think that there's some work you can do to try to build those systems and processes and learn from the experiences of the past.
Randy, you're up. I mean, your spot. Sorry, Caroline, step on you there, but having that insight, the data to bring forward is critical. But I think the other piece that's critical is cultural, right? The board needs to be willing to listen and hear. And if you don't have that, it doesn't matter how much data the chief financial officer or the chief risk officer brings forward, it's not going to be listened to, it's not going to be acted on. So I do think it's both the identification and data, as you talked about, but I think it is also culturally, what is the culture of the board and the board members to be receptive to hearing those things?
Right.
Yeah, and I think marrying it up with a third thing, it's the culture. Like Peter said, it's the information, like Randy said, and it's the instincts. And that's what kind of the board talent piece comes in, because you can have a great culture that encourages asking questions, pushing back, being an effective challenge, and you can have great reporting. But if your board composition doesn't have the right mix of folks with the instincts to know when to ask or how to interpret, you're at a disadvantage. That's not to say you can't function, but it's not optimal.
And if I can add a final thought on the risk management, I like this idea too, that you have to have instincts, and some would say curiosity. You gotta, well, how about that? I think too, if I can just speak to risk management programs in general, I've been to a few seminars lately where it's like every bank has to have this program with this, this, and this. And I look at it and go, well, that's one crappy risk management program. It's a lot of ratios, but it's not really changing the way risk is managed. And so I will go back to culture, which is whatever happens in the bank, that employee that's on the front line, if something starts to change, someone's going to see it first, right? If you look at instances recently of paper check fraud, of all things, the thing that we're like, yeah, that's kind of boring. And now all of a sudden, paper check fraud is the primary fraud that we're seeing in banks. Some of those first line people are the ones that are going to see things starting to come through that just don't look right. And so I would just emphasize this as you think about risk management. It is certainly about building out numbers, but it's also about building out culture, where everyone in the organization is empowered to be able to feed what they are seeing into the process. Certainly someone has to filter that for the board, but I feel a lot better as a board member knowing that everyone is invited to participate.
Excellent point. Any other additional thoughts around this topic? Randy?
Well, the only other thing, I violently agree with all the points about culture, curiosity, and data. And one of the things too is to be mindful of is the right data. I've talked to a lot of boards, leaders who have copious amounts of metrics, but again, that goes back to the what is actually actionable. What insights am I supposed to draw from this, and how do I effectively govern? So it all fits together. If you've got the right culture, the right curiosity, you are challenging those metrics, not just what they say, but what they mean. And again, because there's so much transformation, there's so much change. The metrics that served you yesterday may not serve you tomorrow. Good metrics programs evolve with time. They're really telling the story of how you're evolving the business. And you need to be, continually thinking about, are we looking at the right metrics, and are those metrics being gathered in a way that are really telling the story, and have that skepticism, curiosity, outside perspectives. Again, not having everyone with the same background and experience helps you get those orthogonal points of view that really drive the conversation to the next level.
Excellent. Peter, any other additional thoughts?
I was just going to say that to me is a wonderful compliment to what Julie said, right? You can go to these seminars and they give you this list of metrics. Well, they are not all pertinent to all banks. And as Randy said, not just how the bank's business evolves, but as the industry and the economy evolves, you have to be looking at your metrics constantly saying, is this one still relevant? Is this one still relevant? And be constantly, as he said, keeping them alive. And so I think those are both great points about how you can't just use a system off the shelf, and you do have to be sure you're constantly reevaluating the metrics you're monitoring.
Peter, I remember, again, back to our legacy SVB, but I remember my first question to Simmons Bank was, what's our ratio of uninsured deposits to backup lines of credit? Because we were obviously going into a volatile period where no one knew what their deposit stability would be. Well, how many banks had that on the risk scorecard? None, because it was not relevant until that hit. And so I think taking those situations that occur, whether we like them or not, and self-evaluating how they can or should fit the banking organization is an incredibly useful tool to keep those metrics fresh.
Absolutely. Excellent point. Thanks for sharing that, Julie. Any other points to add? Okay, so that leads us to our next question. So how do we actually source risk management, regulatory, cybersecurity talent for bank boards? Any thoughts, insights? Let's start with Caroline.
Sure. So this can be hard, especially for smaller institutions, regional or very local banks. The first step for those smaller institutions, and that was kind of the focus of the article, is, look within your local community. There may be more interest there than you think. Think about also the types of expertise within banking, somebody may have banking expertise and you're reading this article and you're thinking, well, that's not enough. I also need risk management expertise or IT expertise. Those can actually be, subcomponents of banking expertise. And so looking beyond kind of labels to think about what actually could complement what we have going on with management. And then, I would be remiss if I didn't say to make sure that when you're sourcing talent for bank boards, not to just look for a diversity of, expertise and experience in these substantive areas, but to also look for a diversity of viewpoints, beyond just what your board has historically looked like for the past, 100 years. If you're a bank that's been around for a while, does the makeup of your board more broadly reflect the makeup of our society? Do you have women at the table? Do you have minority representation on your board? And to take that into consideration also when you're sourcing talent.
Right. Julie?
Oh, I think this is by far the hardest question of this whole segment, because I absolutely appreciate everything Carolina said. And yet we can go to examples where we say that bank tried to do that. And I think you would agree, they didn't actually pick the right people. They may have got what they wanted in terms of demographics and other things, but you still have to be sure that the skill set that the individual brings to the table is an applicable skill set and one that can add to the value of the organization and not become a distraction from what the organization needs to be done. There's always this fine line between challenging and becoming obnoxious, for lack of a better word. So I think that too has to be measured. You want, of course, good CEOs want board members who challenge, but we also want board members who can work with others to be sure that it leads to a good outcome. The other thing I might add, I'll put back my pitch for people that have had broad experience, banking experience or near banking experience or regulatory experience. I don't think you need a board of them, but I do think that as individuals come through those particular channels or other financial channels, it could be investment bankers, this ability to connect all components of the bank and understand how one affects the other and how an outsized risk in one component can result in, potentially big event if a tail situation occurs. I think that can be very helpful to any board. Still hard to do, but once you've worked in the industry long enough, you are able to say, for example, cybersecurity. I can take those IT exam reports and know exactly what the IT examiners are saying. I can take those third-party reviews that we do from time to time and really comprehensively understand what the findings mean. Or importantly, I know we've talked a little about data. I get what it means to bring up a data warehouse, and it's hard to do it right, whether it's data quality or just simply keeping, as that warehouse grows, keeping it operating efficiently. So finding someone that has touched many aspects of the bank, I think, can be very helpful to a bank board.
Right. Randy?
So I think, there's knowledge and then there's wisdom. And I think it's important to think about both dimensions. You certainly need knowledgeable. You need people who have check all the boxes, can understand their business, can bring something unique to the table. And you also need people who are going to be thinking critically, are going to be adding value, all that. And it's really hard. I mean, it's hard hiring people, right? And, a lot of times I use do they have the knowledge and can they get the stuff done? Again, they're two complementary skill sets. And so I think you're really looking for those indications that the person with knowledge can put them to use in a constructive way. As Julie alluded to, that not everybody with knowledge is constructive. And I think there's also, evidence of having done this before, either being on other boards is helpful, or they come highly recommended, or boards that have worked with them as an executive, kind of see them as a peer. I think, again, I love to be the data guy, and certainly there's a lot of data that goes into these, but some of it is feel and referral, and going to your advisors and ones that you trust, and then using them to help to find to validate that the right people are in the right places. I won't pretend though that I have a whole lot of expertise here, other than to see the recognize the problem, and when I'm hiring in my own business, it's a similar, although a different scale, and it's something that needs to be taken very seriously. One other thing too is I think there needs to be a good conversation about firing and how people who don't work, and what's your governance structure for getting them out. Because I think that, again, taking the employment answer, sometimes the problem is you just don't have the right person for the role, and the sooner you recognize that and get them out, the better. That's not always easy to do, depending on the organization and the governance and stuff, but that should also be part of the conversation.
Excellent. Thank you. So, Julie, as a former regulator, you bring a unique perspective to the board. How has your regulatory expertise background helped you in your contributions to Simmons board?
Okay. Well, so far they have said I've been an asset, so I'm hoping that that's the case. I really feel like it's been a great experience for me. First of all, being on the regulatory side of banking, I did learn a lot, and I did see a lot of banks operate, and I saw a lot of banks operate poorly. And so being able to come to the table now and bring that background, I think probably has been beneficial for all. But I'd say specifically within that, there are probably a couple things that someone with ex-regulatory or maybe ex-banking experience can do. And one of those is calibrate what the regulators say. Now, for me, that's particularly easy because the regulators happen to be the Federal Reserve Bank of St. Louis, where I was in charge of supervision. So I know the people and culture. And I will say they don't give me any breaks, but I also don't have any hesitation saying that's not right. You didn't look at this. So, but also I think when you do find things, particularly as it gets into suggestions, it's not going to go into the report as a matter requiring attention or matter requiring immediate attention. It's more advisory. You know, a lot of suggestions get made in examinations that I'm not so sure if I knew they were being made as a regulator, I'd say that's okay. I'd probably say don't make those suggestions in some cases. So as matters come to the board table that, well, the examiners brought up this matter, as a former regulator, it's pretty easy for me to calibrate and say, I wouldn't worry too much about that. That's nice, or it's way too early. Let's not jump into that before we have a better understanding. And that's been particularly valuable, just trying to gauge things today, like the Consumer Financial Protection Bureau and junk fees, and how far is that going to go? And so I think that's been useful. The other thing that I think has probably been beneficial in bringing a former regulator on a bank board is this idea of, you know, over the decades, you do see a lot of risks. And guess what? They're a different form every time they occur, but fundamentally, there's some consistency in the risks. You know, too much leverage against real estate is always one of my favorites because in low interest rate environments, it's real easy to go whole hog and then have issues from it later. But also liquidity, bringing someone in with the experience of having been through multiple cycles. Some of us remember the savings and loan crisis and know exactly what liquidity meant. And you add to it some of the things like the, you know, different legislation that's occurred. And you are able to say, it doesn't matter if you have those backup lines of credit. What matters is how much capital you have, because those backup lines and the discount window and all others are going to be gone if capital starts to diminish. So I think some of that has been helpful. I hope so. I've been told it is. But that longevity, I think, can sometimes fill gaps, particularly when banking organizations have had changes in leadership and maybe don't have as complete an experience from the course of time.
Excellent. Caroline, what do you see as the potential liability for a bank that does not have the appropriate skill set and regulatory talent on the board? What are you seeing, if you would like to share with us?
Sure. So, you know, best case scenario in that situation, the bank won't as efficiently and effectively achieve its objectives, right? And you know, its business objectives. But I am a lawyer, and so I have to also talk about the worst case scenarios, which is if you don't have the right talent on your board and you have some compromises in the other aspects of an ideal board that we've described here, you know, information, culture, curiosity, instinct, then worse things than suboptimal performance could happen to your institution. There could be supervisory findings, particularly in the management rating of the CAMELS ratings, which also encompasses board and senior management, not just the management itself. And then beyond that, you know, if there's more than just MRAs, and that's not to minimize them, and apologies, you'll hear a siren going by in the background, but maybe that's appropriate for this topic. You know, beyond MRAs, there can be enforcement actions, not just against the bank, but, and this is something that's not meant to scare, but just meant to be realistic, that as a board member, you are an institution affiliated party and you have fiduciary responsibilities. You know, to fulfill when you're in that role for a bank. And so just making sure that as part of that, when you're thinking about as a board as a whole, who is making up this board and how are we working together in the best interest of the institution, it becomes critical for those personal reasons as well. And then the final thought there is a potential liability for a bank without the appropriate skill set on the board. I think it's important at this time for the reasons that we've been talking about, the expansion, the rapid expansion of technology and new ideas about what banking should be, because as competition increases, not just with other banks, but with non-banks that are increasingly in the mix here with like financial products and services that are kind of maybe in partnership with banks, maybe on their own as licensed entities through the states. Banks may be incentivized to try new strategies, new technologies, or new products. The business has an idea. It's, the board is hearing about it in the meetings. And boards need to take into account whether their membership has appropriate experience and expertise to think about these initiatives and question them, not just at the outset, but as an ongoing matter, especially if they ramp up over time.
Excellent. Next, I'll move on to Randy. Cybersecurity is critical with the increase in digitization in banking. Talk to me about cybersecurity and AI. What should be at the top of the mind for boards and executives, and how can board expertise in cybersecurity help combat AI cybersecurity threats, and how should they be thinking about strategies to mitigate threats to customer data protection?
Sure. So, as I mentioned earlier, the AI revolution is upon us, but it's also not necessarily new. And certainly there's been machine learning and AI as a core part of finance for some time. And again, the financial services sector is a little bit further ahead than others, I think, by virtue of having gone through the housing crisis, the financial crisis in 2008. There was a lot of look, especially at the biggest banks, in terms of things of data governance and visibility into the assets you actually have, and all sorts of stuff that you were doing, and also model risk management, which is a great and important practice that needs to be extended to cover generative AI and other things like that. So first, recognize that being in an industry, you have a leg up over maybe some of your peers in other industries that are facing the same kinds of pressures to change and risks. As I mentioned, cybersecurity is just going to continue to be a growing force that you need to prepare and defend against. And even if you do nothing with AI and machine learning, your systems need to be secured. You need to be sure that the people who are doing things within your organization are the right people with the right access. There's a concurrent thread with insider risk, whether it's a disgruntled employee or if it's a hacker who's gotten someone's credentials. Either way, they can do bad things, and so you need to have systems and processes in place. If you've seen any of the deep fakes, the ability to really effectively write phishing and spear phishing and all sorts of impersonation campaigns, you can buy every product that everyone sells, but you will still get breached. And so it's about having concepts like zero trust and knowing that when you have a breach, that the blast radius of that is contained, and that you're really thinking systematically about your security. And this is something too that the smallest organizations and even mid-sized companies that don't have the resources of the systematically important banks, they have to do it too, because they're just as much a target, and obviously they don't have the same resources to deploy. So looking at managed partners, looking at different ways to mitigate those risks is an ongoing conversation that's just as important as the credit risk and the financial risk and all the other things that banks have to manage from a risk perspective. So that's on the attacker front. On the transformation front, then, you do have this transformative capability that is giving non-banks the ability to do what you do at a lower cost basis. You think about how many people it takes to execute a transaction or do something in your business. And again, the generative AI advances over the last year and a half have all been about extracting information, summarizing it, and using it in another way, which is a lot of what knowledge work is. So how do you enable knowledge workers to work with AI to help them to be more efficient, but also not run into another kind of risk, which is over-reliance on AI? Just like the board and the metrics always change, if you buy an AI product that's been trained on general data, or even if it's been fine-tuned once and it looks really good for you in 2023, your business will change. Do you have the right support structure in place to continue to update those AI models? AI is like a very fast moving member of your employee base. They can, if your employees can access the wrong data, AI can access it faster. If your employees can cause havoc, AI will cause havoc. So again, a lot of this foundational stuff with cyber is just being ready because AI is going to enter your environment one way or another. And it's also a lot of organizations are doing really great things with piloting it and trying it in a controlled fashion. There's also a shadow AI because these tools are everywhere. They're easy to download and install. They can do lots of really cool, powerful things. Just like with the previously called a shadow IT. There's a lot of risk and a lot of opportunity. So back up at the board level, I think it's important to think about these things as capturing the innovation and the benefits without you obviously you don't want to stop progress, and you need to be playing in this space and building those capabilities, but you have to have a real cross-functional head on. It's not just an IT thing. It's not just a data thing. It really does touch the whole business. And so, and again, where we've seen organizations really do the best in this space, it comes from the board where, and again, like the last year, we've spent a lot of time talking to boards and leaders about why it's important. But the board needs to be saying, we need an AI strategy and an AI policy, and they need to empower, managers so it doesn't become a silo thing, and it doesn't become, all the ways that initiatives like this break down, because it is will continue to transform business. And so it needs to be something that is well governed and well considered.
Excellent. So Randy, with the recent SEC cybersecurity rule, obviously the board oversight role expectation has increased dramatically for public companies. Any thoughts on that?
Yeah, I mean, the first thing I thought when the rule came out, is the fact that you have a reporting period that is rather rapid considering how fast some organizations move. And so you need your data to be in good order. You need to be able to provide the SEC or any regulator, answer the questions that they ask in a timely manner. And again, that's where in financial services, we've gotten really good at that because we've had to. I'm hoping this is a bit of a, drive cybersecurity to be a bit more mature as well in that data provisioning space. But it just highlights how important, it is. A lot of times there are a lot of bad guys in the cyberspace, but a lot of the risk comes from, state actors and folks who are attacking our businesses because they're American, or they have a particular political or policy agenda. And the fact is there needs to be engagement, and SEC is obviously a one place, but it's an ongoing conversation between CISA, between Department of Homeland Security, behind a whole bunch of stakeholders that touch the cyberspace, to make sure that there's good intelligence coming in about what those risks are, that there's good reporting of what's being seen. It's a very sensitive thing to report a breach and to coordinate, but it's not ever. It's becoming less and less an individual company is targeted, right? All the hospitals are targeted, or all of the organizations that are affiliated with an industry or with a particular policy in the government. So information sharing, which is not something that is typically a comfortable thing, is also important. And so again, regulators and government agencies play an important role in making that happen. And I think that the SEC regulation is pushing towards that direction for public companies, and private companies should think, if I had to do this, what would it take me? And who knows, in the coming years, depending how dramatic ransomware breaches and other things tend to be, we may see additional regulation, or we may see it come from the insurance side of needing to require better disclosure, faster disclosure, and making sure that data is high quality so you can drive decisions from it.
Appreciate the insights, Randy. My final question is to Peter. What do you see as the concerns from the talent gaps on bank boards? I would like to hear from your perspective as a CRO.
Yeah, I touched on this a little bit earlier, but when I see the talent gap on the board, it gives me pause, because there's not now that challenge of the cyber policy or the cyber program. There's not that challenge of the enterprise risk program. There's not that challenge of sort of the IT policy. And as we talked before, that culture of challenge, some of us called it intellectual curiosity, to me is vital, because that's when you start to uncover where there may be risks. And only when you uncover a risk can you mitigate it. And so that's why I think this talent gap, and it's cyber, it's overall risk management, it's even regulatory representation, is really critical for the banking sector in the United States.
Excellent. We are now at the end of the podcast. I want to thank you all, Caroline, Julie, Randy, and Peter, for joining me today. It was a fabulous conversation, and I greatly appreciate your thoughts and perspectives and insights. Thank you.